The Federal Reserve extended its year-long fight against high inflation on Wednesday by raising its key interest rate by a quarter point, despite concerns that higher borrowing rates could worsen the turmoil that has gripped the banking system. Speaking at a news conference Wednesday, Fed Chair Jerome Powell said the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. The Fed is deciding, in effect, to treat inflation and financial turmoil as distinct problems to be managed simultaneously by separate tools, such as higher rates to tame inflation and greater Fed lending to banks to calm financial turmoil.
As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity.
Federal Reserve Chairman Jerome Powell addressed the ongoing banking crisis Wednesday, insisting that the U.S. banking system is sound and resilient with strong capital and liquidity. Speaking in Washington, D.C., moments after the Fed announced that it would raise the key interest rate a quarter point. At the same time, the Fed warned in a statement that the financial upheaval stemming from the collapse of two major banks is likely to result in tighter credit conditions and weigh on economic activity, hiring, and inflation.
Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system.